All right. Today is Sunday, the 20th of October. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. And let's dive right into it. A little bit serious today, but time is of the essence. In last weekend's show, when we talked about the market setup, we discussed the hierarchy of events. And we said it's going to begin with technicals at number 1, earnings number 2, geopolitics number 3. Then the Fed policy, what impacts the Fed policy, at least last week, was retail sales. That's at number 4. And then at number 5 comes the elections. The hierarchy of events will change throughout the week. That's what we said. And the change of hierarchy of events throughout the week offers different trading setups that if you can exploit, you're going to score big. Now, I'm going to show you how the hierarchy of events changed throughout the week and the hierarchy of events for this upcoming week. But before we talk about that, when we say technicals, what does that mean? Does that mean that charts, we just look at candlestick patterns or trend lines, moving averages? Sure, but it also includes the indicators. And those indicators move a group of stocks together, up or down. The first one, of course, is bond yields. So what you're looking at right now is the 10-year yield. We said in last weekend's video that my anticipation is we see a pullback in the 10-year yield and bond yields all together before retail sales. And then we'll see what happens with the retail sales data. And if that is the setup that we see, we're going to have a reliable trade that we can follow Monday, Tuesday, Wednesday, because retail sales came out Thursday. And the trade was to go along some of the yield-sensitive risk-on assets. And I chose the IWM small caps and the KRE regional banks. All of them outperformed the market Monday, Tuesday, Wednesday, and even after, when we got retail sales, we didn't see a big pullback in these names. They pulled back Friday, I believe, because we've seen some profit taking. We'll talk about that in a minute. Now, the IWM and the KRE are part of a group, the yield-sensitive group, which we say pick, depending on the time, depending on the hierarchy of events, depending on the week. But we know that when bond yields go down, at least from a technical setup, with no context, meaning with no influence of the macro data, because that changes everything. We'll talk about that in a minute before the end of the segment. But when bond yields go down for a technical reason, it is positive for assets such as the IWM small caps, the KRE regional banks, the XBI biotech, the XHP home builders, the ITB construction, and names like Blackstone, really yield sensitive. And you would notice that these names were the outperformer this week because we've seen a dip in bond yields. But it was a technical dip. It wasn't anything related to the fundamentals or a break in trend where we say, oh, we have recession fear or inflation fear. Once again, we'll talk about that again in a minute. But the other indicator is the dollar. And if the dollar goes down, again, with no context, no influence from the macro data or the Fed policy, if it's just a technical pullback, it'll be good for these kind of assets like gold, gold miners, energy, silver, copper, emerging markets, Chinese markets, fertilizers, agricultural names, some of the industrials that rely on a weaker dollar like Caterpillar and Deere, assets like uranium and natural gas. And again, before the week began, my anticipation was that we see the dollar moving down with bond yields Monday, Tuesday, Wednesday before retail sales, and then we'll see what happens. We've seen an opposite picture where bond yields went down as we anticipated, but the dollar actually kept going higher. So this trade here did not work out as good as the IWM, depending on what you chose, the IWM and the KRE, because those had the support of bond yields going down. But then we've seen something really interesting. After retail sales, specifically Friday's session, the dollar dipped down, and immediately we've seen these assets moving higher. And you've seen a huge squeeze in silver, and gold miners went significantly higher. So when we look at the setup for this week, the dollar is way overextended, and maybe there was a delay in reaction where the dollar is going to begin to pull back this week. And again, if you understand that, it's going to open a trade for the dollar-sensitive assets. You go along these assets until we face a macro event that adds context to the dollar and moves it up or down. Now the question becomes, well, what about the big caps? Because that's what really moves the market. See, the market, quote unquote, is not really that interesting right now because we're in a phase where the dollar and bond yield sensitive assets offer the best and the most interesting trades right now since we're in the debate of soft landing. No, we have inflation risk. No, we have recession risk. The movement in the dollar and bond yields offers the volatility needed to bring up really good setups for trades in these sensitive assets to the dollar and bond yields. The mega cap technology stacks, the AI mania, that's a theme of its own. It's not really that sensitive to bond yields or the dollar. They move algorithmically based on hedging activities, so if you see the VIX going down, usually these names go higher, VIX goes up, they go down. They're also reliant on options activities, and most importantly, as we will see not this week, but the week after, on earnings. We have a lot of earnings coming out for these names. Once again, not this week, but the week after. So for now, the actual technicals, forget about the indicators, the actual technicals for these names matter. And you'd notice that the big caps been diverging since the summer. They used to move up together, down together, with few exceptions here and there. But since the summer, when we've seen the tops in July in certain names, we have seen divergences where these names move based on their own indicators and their own technicals. So we have to look at the technicals of these names independently and make a judgment based upon them. They're important because they move the indices. The dollar-sensitive stuff and the bond yield-sensitive stuff, those are too small to move the indices. So if you look at the Amazon, for example, you look at the weekly chart, maybe inverse and shoulder, momentum is kind of turning from bearish to bullish. Okay, we'll put that in sort of maybe the opportunity is to trade Amazon higher all the way till we get earnings. Once again, not next week, but the week after next. Then you look at a name like Google, for example, wasn't a really good close for the week. It was sort of a reversal/negative candle. We have bearish momentum that could extend, somewhat of a bear flag pattern in the weekly chart. So you look at the contrast between Amazon and Google. If you had to choose which one you want to go long for this week, you're probably going to go with Amazon. And if you had to pick which one you want to go short for this week, you're probably going to go with Google, not Amazon. Then you look at other names like Meta. When the weekly chart extended, still in a bullish trend, but could it pull back a little more? Sure. Then you look at another name like Microsoft. It tried to turn positive, but it's stalling here. So can it frizzle out and move to the downside, maybe all the way to the lower Bollinger Bands in the weekly? Sure. So this one, maybe not an easy trade that we can look at here without a break one way or the other. Above the 20 weeks moving average, probably going to be a positive breakout. Below the trend line, we're probably going to go down to the lower Bollinger Bands in the weekly. And you got to remember, we only have 1 week when you can trade these names without the risk of earnings looming large. So you don't have a lot of time, but we're just looking at certain setups here to play some lottos for the week if you want to trade the big caps. And of course, we're going to look at Apple and Nvidia as we usually do in the charts analysis. But if we're going to do a summary here, Apple on the bullish side, turning a little more bullish. Nvidia was the most bullish for the week, maybe a little too hot, moving down a little bit. As you've seen in Friday's session, Amazon may be improving a little more, so I see that as the opportunity on the long side. If you look at the bearish setups, Google obviously the most bearish. If you look at the chart, it might turn even more bearish this week into its own earnings, and then we'll see what happens. Meta was bullish, but it's pulling back, so it's moving toward the bearish camp. Microsoft was turning bullish, now kind of stalled. Maybe it turns more to the bearish side. So you have to do your own analysis here and pick whatever you like. You want to have a long trade, a short trade based on the technical setup for each of these names, then have at it. But we go back to the hierarchy of events. Once again, the anticipation was technicals will be number 1. As we see bond yields and the dollar moving up or down, we were anticipating a move down into retail sales, then earnings, then geopolitics. Then as we get retail sales, that's going to be number 4 in the beginning of the week, but probably going to be number 1 once we get the report. And then the elections. Let's see how it played out. Right off the gate Monday, we have seen a change in the hierarchy based on the news that we got that perhaps Israel is not going to attack the Iranian oil facilities. So all of a sudden the geopolitics went down and the Fed policy became more important to worry about. So it moved to number 3, geopolitics moved down to number 4. Then Tuesday, we got earnings from ASML, and the company offered a warning sign that perhaps AI demand is slowing down because they showed lower bookings year on year. Immediately, we've seen earnings taking over technicals, where earnings became number 1 and technicals came number 2. And we've seen that AI earnings mattered more in pulling back the chips, and given the weight of these chips and the AI names, they pulled down the indices with them. But if you notice that the IWM, for example, which is yield sensitive, didn't really give a shit. It kept going higher. And the home builders, the regional banks, anything that yield sensitive, it wasn't really, ASML was not really concerned with them. The concern was, I'm looking at the chart of bond yields, going up or down. Now, what is the context? Good reasons or bad reasons? Well, they were going down for no reason at all, just for a technical reason. And that allows the IWM and the yield sensitive stuff to go higher. So after ASML was out of the way, Wednesday, technicals came back on top, earnings went down to number 2. Then we got to Thursday's session, where we got retail sales. Immediately, retail sales came at number 1. And during the same day, we got earnings from Taiwan, which kind of negated the warning from ASML. So earnings were at number 2. Then number 3, the technicals. But something took over really fast, the entirety of the hierarchy of the week. And that was OPEX. We had a major trillions and trillions of dollars of options expiration Friday. So immediately, once we got the digestion of retail sales and earnings from Taiwan, you'd notice that during that day, the chip names didn't really react so positively to Taiwan's earnings. And there was a reaction to the retail sales data in the market, but then we forgot about it, and OPEX took over. We explained that in details in our Discord, that look, the market maker is looking for the positioning of options, and this is why they're going to move the SPY down to this level, to this number. And then we'll see what happens Friday, but we will be dominated by OPEX as we head to this upcoming week. What is the hierarchy of event looks like? Well, still at number 1, because OPEX is behind us now, we have technicals. So dollar, if it moves up, if it moves down, it will move a certain class of assets up or down. And the same goes with bond yields. And then you have the VIX going down, probably going to be good for the big caps, aka good for the indices. The VIX hedging showing up and going higher, probably going to be bad for the big caps and bad for the indices. And then, of course, there's the individual technical setup in these big caps. Amazon maybe looks better than Google, you know the deal. So Monday, Tuesday, we're probably going to be dominated by the technicals. Then what happens Wednesday? Because you look at the earnings calendar, Tuesday we have Verizon, Raytheon, Freeport, 3M, GM in the morning. After the bell, we have Texas, important name, but again, none of these names have a huge weight in the indices or huge influence on the AI mania, which is the dominant force in the indices. You go to Wednesday, you're going to have some AI names or AI-related names reporting, beginning with Vertiv. That's a power play on AI. So if they show weaker demand, then it's going to be a problem. And after the bell, we have names like Lam Research and IBM, both of them in the hardware side of the AI mania. Are they going to confirm ASML or negate it? So I think Wednesday, the hierarchy becomes earnings, then technicals, then the Fed policy, which this week we're not going to look at retail sales. That's behind us. What's going to influence the Fed policy is the PMI. Comes out Thursday. Then geopolitics, then elections. This is, we talked about it. Thursday, we're going to get the PMIs. So the hierarchy shifts. The Fed policy becomes number 1. If the PMI shows recession or inflation, it's going to be a problem. Then we have the technicals. Earnings pulled back a little bit, number 3. Geopolitics, elections at the bottom. Now the wild card, of course, is you see a flare-up in the geopolitics. And then that becomes number 1. And of course, we have really tight period of time before we get to the elections. So the geopolitics, if there is a flare-up, a big one, it's going to impact the election risk. So that's going to be a number 1, number 2. And we see earnings and the technicals falling at the bottom. That's the wild card. So again, as we anticipate the week and we set up our trades for the week, you have to understand the hierarchy of events. What's going to be important Monday, Tuesday? What's going to be important Wednesday? And then what's going to be important Thursday and Friday? And if you understand the hierarchy of events, you will understand what you have to trade up or down based on the sensitivity of stocks to these events based on how they influence their indicators. Now, it is also important to understand that we are now in the period that I call the tightrope strategy. So when we talk about the Fed policy and how it impacts things, of course, this week we don't have a hugely important piece of data like the payrolls or the CPI, but we do have the PMIs, and those could be important. So we know right now that we are walking on the rope. And that's the soft landing assumption. It serves a class of assets like the cyclical stocks, retail, transportation, small caps, profitless companies, regional banks, biotech, home builders, constructions, and commercial real estate. But we have the risk of the inflation wind. And the inflation wind serves energy, commodities, metals, and Chinese names better. And then we have the recession winds, which serves dividend-paying stocks, bonds, value, healthcare, real estate, staples, defensive stocks, utilities, and gold better. How do you know which theme we're in? You have to look at the IWM and the reaction to the 10-year yield. So the number 1 thing you need to understand, the hierarchy of events. What's sensitive to the dollar? What's sensitive to bond yields? What about the technicals of the big caps? And after that, what you need to understand is when the Fed policy becomes dominant and leaves an impact in the market, absent of earnings, absent of technicals, we look at the Fed policy as the number one influencer of the market. Now we're looking at themes. Are we still in a soft landing theme where you can continue to stay along these names or pick whatever you like as a short-term trade? Or do you shift to one trade versus the other, where you go with the inflation win and then you short the soft landing? Or you go with the recession win, and then you short the soft landing based on the data that we get. And this week, it's going to be the PMI. The week after next would be the PCE and the employment report. And your indicator to know which theme we're in is the IWM, because that's the poster boy for the soft landing. For example, if you see the IWM going higher and the 10-year yield just moving up a tick, not exploding higher in a big way, just drifting its way higher. What does that mean? It means that we have a soft landing theme where we see yields going higher, no worry about a recession, and then the poster boy for soft landing going higher. And we've seen this theme recently as the market assumes that we're heading for a soft landing. Now, if you see the IWM going higher, but bond yields trending down, not flushing down, but trending down, what is that going to show? Rate cuts optimism. And we're probably not going to see this a lot. This was more dominant during the lead to interest rate cuts when we had some of those light at the end of the tunnel periods that, the Fed is going to cut rates and things were going to be okay. We're going to have a soft landing. So based on that rate cut optimism, we saw bond yields going down, but the IWM gaining. Again, we're probably not going to see a lot of that right now because the rate cuts are already behind us. If you see the IWM going down and you see the 10-year popping higher, that we are at the inflation fear, so you know how to position yourself. If you see the IWM flushing down, with bond yields flushing down, then we have the recession fear. And you know what class of assets you have to go with. The defensives, the dividend paying, the value stuff, gold, healthcare, and you probably want to be short the soft landing theme. If you have the inflation fear, you probably want to go long metals and short the soft landing. And again, the big caps, that's a sphere of its own. Of course, recession fears will have an impact because if you get recession data and bond yields drop down dramatically, asking the Fed for more rate cuts, the likelihood is the VIX will move higher, and the VIX will have an algorithmic selling impact on the big caps. We've seen what that looks like in the month of August. But these big cap stocks, they tend to forget about recession fear and inflation fear fast because they have their own indicator. And that indicator is, what about the demand for AI? The majority of that spending comes from either governments or companies spending, buying stuff, AI stuff from other companies. It's B2B. So it's sort of independent from the external factors in the economy and consumer spending and all of that. Of course, it catches up in time. If the consumer gets weaker, if the unemployment rate moves higher, then companies begin to pull back in spending. And you've seen that a warning sign from ASML, for example, impacted the big caps and the AI chip stocks stronger than any catalyst did before when it comes to inflation fears or recession fears. So keep that in mind. And again, based on the discussions that we just had, on Friday, I issued this on Discord. We've done a few lottos for this week since we anticipate the dollar to continue to go down. We want to be long some of these dollar-sensitive assets, so we picked some long trades on FCX, that's copper, FXI China, and of course Bitcoin, so we picked up puts on the inverse index for Bitcoin. That's of course with the assumption that the dollar is going to continue to go down. If it pops higher because of geopolitics or whatever, then all of these trades go kaput. We picked up some trades based on the bullish formations that we discussed. Amazon, because it is the best looking chart in the big caps right now. And IWM, for the reasons that we just talked about. We're going to look at the chart in a minute. It looks positive for now. But the assumption is bond yields not going to be impacted with context until the PMI is Thursday. So the assumption is with no context, if bond yields just consolidate or trend down a little bit, it could be good for that soft landing theme. It could be good for the bond yield sensitive theme, among them, of course, the IWM big caps. Now let's add more color to this conversation by revisiting the market information for the week, beginning with the closing of the indices on Friday. And here we go. The diamonds closing barely positive, up by 36.86 points, or a gain of 0.09%. The Nasdaq positive by 115.94 points, or a gain of 0.63%. And the S&P 500, the spider, also positive 23.20 points. The impact of the big caps, the Nasdaq is up. You're seldom going to see the SPY down, or the S&P in this case. So it's up 0.4%. A technical pullback in the Russell 2000, the winner of the week, down about 0.47 points, or a loss of 0.21%. Looking at these sectors on Friday, the dollar went down, and all it took just a little pullback. And we've seen explosion squeezes in silver and gold miners. We didn't see it in copper just yet, so we want to play copper as sort of a catch-up trade. And then you got real estate. But the laggard on Friday's session was energy. Now we'll look at the contrast for the week. And the winner is utilities, followed by real estate. So you notice the defensive formation in the market. It ain't led by comm services or technology. We made a video throughout the week. What happens when we see utilities taking over technology as the number one performer for the year? And we've seen that phenomenon back in 2007. We've seen it back just before the crash of the dot-com bubble. So again, the fact that the defensives are leading for the year, utilities is the number one performer for the year, even better than technology. It doesn't bode pretty good for the market later on. Of course, the counter argument is, but the majority of the gains in utilities are happening via AI plays, the power plays. Well, you got to remember that we've seen the same phenomenon during the dot-com, where electricity companies, power companies were also catching a bid because we're going to have the internet now. We're going to need more power. All of that was valid as an argument, as a fundamental argument. But at the end of the day, the bubble went bust. Anyhow, let's look at the breadth on Friday. The NYSE 53% advancing, 45% declining, and the Nasdaq 54% advancing, 43% declining. We have more 52-week highs versus lows in the Nasdaq, so the breadth all in all was positive. Most of the influence was from OPEX. You look at the map on Friday's session. The majority of names in the green, led by Apple, got some good news from China, allegedly. We'll see if that's going to stick or not. We got Netflix with earnings, of course. American Express went down because it got bad earnings. At least the market thought about it as bad earnings. The report itself was not really that bad, but perhaps already priced in. But the other reactions, you see the winners on Thursday were a lot of call buying took place, like Taiwan TSM. It reported Thursday, blasted higher, so we have the folks chasing call options with the expiration date of Friday, trying to score big. And the market maker says, no, not under my watch. I'm not going to reward you for way out of the money call options where I'm going to be on the hook. I'm going to drop it down about 2.5%, make sure all of you lose. The same goes for ASML. It was actually positive on Friday. Why? Because it was the laggard for the week. A lot of folks buying puts, assuming it's going to go down with Friday's expiration, of course. Market maker says, not under my watch. I'm going to move it up to make sure that most of you guys lose. What's interesting on Friday's session is the comeback of medical devices. So we got earnings from ISRG, and it was positive. We've seen a move up over 10% for that name. But it also moved names like Stryker and MDT, and Boston, and Edwards Life Sciences. So pay attention here. It might be the theme that was lagging for a while that begins to come back again. And it has exposure to dividends, so it can be part of the defensive theme too. What's really interesting on Friday, of course, rebound in China, BABA, JD. They were heavily shorted into Friday again. Folks want to buy the Friday put options. Market maker says, nope, I'm going to move it up, make sure most of you guys lose. What was really interesting was the outperformance by gold miners. They exploded higher along with silver. So we'll talk about that when we talk about the charts and again the heat map for the ETFs and the commodities in a minute. But let's contrast this map with the weekly heat map. And here you can see a different picture. We can see that we have intra-sector divergences. Let's begin with the big caps. You have Apple up, Nvidia up, but then you have Meta down. In the chips, we see the hardware, ASML, AMAT, all down, including AMD, which is a designer, not a hardware, but AMD went down too. But then we see Taiwan, Nvidia going higher. And you see here the divergences are happening because of the technicals and again, the earnings. When they come out, instead of impacting the entirety of the sector. And that reflects the contrast that we got in earnings. For example, ASML showed bad, or let's say a warning signal. It wasn't really a bad report. It was just a warning about the guidance. But then Taiwan negated that. So the thinking goes, maybe it's a problem for hardware. Maybe it's a problem for China demand, since we have the export restrictions. And that's going to impact ASML, AMAT, LAM the most. But maybe it's not an issue for NVIDIA. And you see that debate going on in the performance that you see right in front of you. As far as the big caps, the technology stocks, the technicals are dominating. Meta got way too hot, so we see profit taking. Then Apple got some news and made a technical breakout, so we see folks chasing it. The financials dominated by their own earnings. Then you see the bond yield sensitive theme. When bond yields go down in a dip, we've seen that Tuesday, Wednesday. You see real estate, utilities, the dividend paying stocks performing. along with the defensives. When you see the dollar ticking down on Friday, we see the metals, so we see gold miners moving higher. Not so much for copper, was down for the week, so we'll see if that's going to play a catch-up or not. And folks, just by looking at this map, it's a clear illustration that we're now in an active/pickers market, not the passive market where you just bought the indices or you bought certain ETFs like the chip ETF or technology ETF, and it was just an easy ride. Now it becomes name by name. Looking at the heat map for the ETFs for the week, of course. We got some pullback in China. They say it's because bad economic news, but again, it's not really. It's seldom news. It's huge profits in a short amount of time. That was the easy part of the trade, the short covering. So we see profit taking. And the trigger might have been, hey, bad economic news from China, or maybe the government is not going to issue more stimulus. But we know that the government has no other choice but to issue more stimulus. So that's not the reason why we see Chinese equities going down like the FXI. And I think that once we have the pullback and the weak hands around, you'll see more demand showing up for these names because that's where the stimulus is still going. As we will talk in the macro coverage tomorrow, the easing by the Fed here is under question because we got a beat in the CPI. We got a beat in retail sales, beat in the employment data. So a lot of investors will flock to the Chinese trade again. But for the week, the TLT up a tick, meaning bond yields went down a tick for the week, was good enough to move the yield-sensitive assets, risk on and risk off alike. Risk on like the IWM, the KRE, the XRT retail, the ITB XHB home builders, the risk off like the XLU utilities, the IYR real estate, the Staples XLP, all moved higher. The XLV, of course, part of the risk off yield sensitive, but UNH has a huge weighting in the index, and UNH moved down after earnings, so that's impacting the XLV negatively. But it's really interesting that despite NVIDIA being the leader, which is the reason why, along with Apple, we've seen the SPY and the Qs closing positive for the week. And we've seen the growth, large cap stocks also closing positive if you look at the IWF or VUG. Underperforming value, underperforming mid caps and small caps, got it. But the weight of NVIDIA and Apple moving higher together was good enough to close them positive. But then you look at the SOXX, the chip index, or the SMH, all negative for the week. The XLK, the big cap technology stocks, flat for the week. Another illustration that this is a picker's market, folks. Now, we also had a little dip in the dollar Friday session that was good enough to cause an explosion in silver, squeeze, and gold miners, GDX. It also caused the crypto ETFs to move higher. And of course, crypto ETFs have another tailwind, which is the prospects of Trump taking over the polls. The assumption is we're going to have friendlier policies re Bitcoin. We'll see if that's going to be right or wrong, but for now, Bitcoin becomes sort of an election trade too. Moving on to commodities on Friday, what do we see here? Pullback in oil still going on, and the reason is two of them. China pulling back, the Chinese equities, and then we have the assumption, or the news at least, that we got, that Israel is not going to strike the oil facilities in Iran. Look, whether they strike the oil facilities or not, it's going to be a big hit, and that's going to require a response by Iran, which means tit for tat. And the oil facilities will come as a fair game at some point in that tit for tat process. If it's not in the beginning, it's going to happen later on. So it doesn't matter if the oil facilities are hit or not. A hit by Israel against Iran will cause oil to spike higher. The reason why we see it pulling back is we have folks who are speculating, and they bought oil and they've been holding, the strike didn't happen. So they exit and they cause a drop in oil. That's what we call the weak hands. But if this week you see Chinese stocks that is, coming back up, if you see the geopolitics flaring up again, oil is going to rebound, no doubt about it. But you got to remember another thing that took place over the weekend. We got a leak, and I say leak, wink, wink. It's probably not a leak. It's intentional. But in any case, the leak says that Israel, or exposes Israel's preparation to strike Iran, moving of assets, etc., etc. A minor leak, which tells you that it came exactly from our government with intention to send a message to Israel, look, don't do it before the elections. We see what's happening here. We can leak this. We can leak more important information, and the Iranians might get it. So we'll see if that's going to be a reason to delay the response till after the elections. If that is the case, it's going to be a negative for oil. Or will it exacerbate and speed up the response? As the Israelis say, you know what? We don't want the Biden administration, the Kamala Harris administration. Trump is leading at the polls. All what we need to do is give them a little bit of a boost by striking Iran first, before the elections. If that is the case, we see oil going higher. We see softs pulling back a little bit in cocoa and OJ, but These are still good-looking charts, specifically OJ. Metals, huge day on Friday, the dollar pulling back. That's the most sensitive to the dollar. So we see gold, silver, platinum, copper, palladium, all higher. And I added palladium to my long exposure. If you don't want to use the commodity, you can use the ticker PALL, which is the physical ETF for palladium. All what you need to have is just a little pullback in the dollar, and we'll see palladium going higher, along with the other metals. Now, grains were pulling back Friday. Wheat, soybean oil, soybeans all down for Friday's session. All in all for the week, not good for commodities with the dollar surging higher. But that comeback by silver, absolutely impressive. Huge squeeze, and silver comes on top, the performer out of all futures. The laggard for the week, natural gas, down about 14.5%. Moving on to the big casino options, what do we see here? OPEX, you're going to see a spike in volume, at least in the hottest tables, and that's NVIDIA and Tesla. Apple caught a little bit of steam, but the rest of the market remains, the volume is not here. And of course, folks are buying more calls than puts with the assumption that we have more upside to come. What you need to look at is the IV ranks. Right now, there's no outlier. If we see 90s or closer to 100, then we could have a counter trade. But right now, all what it tells you that we have relatively cheaper options premiums. As the VIX goes down, the premiums go down, which means that this is a good time to position. If you're confident about a trade, you think that Apple is going to blast higher after earnings, or Amazon, or Supermicro is going to crash after whatever. You have relatively cheaper options than before. Looking at the flows, bull versus bear on Friday's session. Bullish flows for MicroStrategy, Gold Futures, Palantir, Supermicrocomputer, the SMH chip ETF, Costco, TLT bonds. We see bearish flow in Microsoft, Carvana, the SLV, so somebody's fading the rip here, MSI. I believe that's Motorola, and then we have Meta, SPY, crude oil, all bearish flow on Friday's session. What we love is the unusual activities, so let's look at some of those on Friday's session. We have a bullish one for GLD. Folks, go back to the summer. We said that this is the time when gold is going to break out. It works in any theme. The only theme that it doesn't work in is the inflation risk. When the dollar goes higher because the Fed has got to tighten, inflation went significantly higher, then gold goes down. But absent of that, it's really versatile. And it's the safest asset you can park in right now. As the market becomes jittery and becomes an active kind of market, and a lot of folks don't know how to pick. So demand for gold is hot, hot, hot. And we got a boost Friday with the dollar going down. Therefore, somebody bought the 255 calls, sold the 265 ones for the expiration date of November 22nd. And all in all, spending a little over $5 million. Then we have another bullish one here for WFC Wells Fargo. Banks responded positively to earnings. Again, the banks, the financials, it's a theme on its own. You can't really assume that all higher yields are bad for this or good for that, because the assumption for now, higher yields, of course, not good for the regional banks because of the assets held to maturity. But higher yields could be good for the bigger banks. So again, this theme kind of depends on earnings, depends on the outlook of the market and the economy and all of that. Wells Fargo responded positively to earnings, and somebody thinks that we have more gains to squeeze here. And they bought the 70 and the 72.5 calls, but for different expiration dates. The 70 for March 21st, 2025. The 72.5 for July 18th, 2025. All in all, spending about $1.5 million. Now, my 2 cents, I don't like the banks. And I think that if we have any recession risk, it's going to come from commercial real estate, because we think that the Fed cutting rates, that's going to alleviate commercial real estate at risk. But then bond yields went higher, so that's not going to alleviate the risk from these assets. And we have Wells Fargo with the biggest exposure among the big caps to commercial real estate. But to each his own. For now, until that happens, the traders and asset managers love the banks. And since we talked about Amazon, perhaps the best looking setup in the big caps, here we have somebody playing it a little longer term though. I'm just playing a lotto. If it hits, it hits. If it doesn't, doesn't. But here we have a little bit of commitment. And somebody bought the 220 calls for the expiration date March 21st, 2025, spending about a little over $1.5 million. And then we have, again, with the theme of if we think the dollar is going to pull back, it'll be good for lithium. So look at ALB. Somebody here bought the 95 calls. The expiration date November 15th, spending a little over $700,000 for those. Another bullish one for you in AAL, American Airlines. We have earnings coming out, I believe, Thursday or Wednesday. And somebody thinks that, as we've seen with Delta, as we've seen with the majority of airlines' earnings, that American Airlines will also witness a positive reaction. The only risk to that, of course, is American Airlines been going higher on the heels of Delta, on the heels of United Airlines, so it might have already priced in any good news. But in any case, they think that we have more upside to come, at least the buyer side of this trade. The seller, of course, probably owns the stock, and they're selling a upside call, a covered call, as a hedge. From the buyer's side, though, the 14 calls is what they bought for November 29th, 2024, spending a little over $1 million. Then what about the bearish trades? They continue to bet against the IWM, and I showed you the two scenarios where the IWM goes down. The inflation risk, where we see bond yields exploding higher, or the recession risk, where we see bond yields collapsing. So unless you see that's happening, you probably don't want to bet against the IWM. But maybe they see something happening soon, and that's what they're betting on, because we see millions and millions of dollars betting on the 225 puts, the 203 puts. But the most important one is the 225 puts, because that's the nearest expiration date, November 15th. So we're going to look at the chart of the IWM in a minute and try to assess what kind of risk are they seeing with this kind of trade. And it goes hand in hand with the RKK, also a really yield-sensitive risk-on kind of assets, because Mama Kathy loves the profitless companies, so her ETF is not going to thrive until we see the profitless companies going higher. If somebody's betting against them, they're betting on a bad outcome from either the inflation risk or the recession risk. In this case, they bought the 43 puts, the expiration date November 15th, spending about $450,000. Then we have GEV, GE Vernova. We have earnings coming out for this name this week, I believe. And somebody is betting that we see a reaction to the downside. They bought the 270 puts. They sold the 240. The expiration date this Friday, so we know this is an earnings play. They spent a little over $1.25 million. Do they have any insider information? Who knows? But they seem a bit confident in this trade. And lastly, what about the ticker SN for Shark Ninja? The chart is on fire. One of the hottest stocks as of late. But somebody's fading the rip here. They bought the 100 puts and they sold the 80 for the expiration date of November 15th, spending about $2.7 million. Let's move on to the charts and then wrap it up. Beginning with the SPY, the S&P 500 hourly chart. What do we see here? Can you trade based on the hourly chart? It's not going to give you a lot. You have a positive trend line, sure, coming out of consolidation, but you see that this is pretty much in line with how NVIDIA reacted. So SPY impacted by NVIDIA. You break the trend line, I guess you have more downside to come. You break the highs for the week, the flush down candle, then you can continue to advance higher. But let's be honest and not pretend that the technicals here matter at all. NVIDIA moves up, SPY is moving up. NVIDIA goes down, SPY going down. And Apple, of course, is another important name along with NVIDIA. If you look at the weekly chart for the SPY, you'll see this sort of a rising wedge pattern. We're trying to close above, and we'll look at Apple and NVIDIA in a minute. Both of them gave sort of a positive breakout. So the SPY is reflecting some of that. But you got to remember that the SPY also has weight in other names. So the escape of the rising wedge for the SPY in the weekly chart depends on the continuation of the outperformance by Apple and NVIDIA, and then other names also joining the rank. Is that too much to ask? I leave that up to you in the comments section. Of course, we have earnings, and that's going to dictate where we go. Now we look at the Q's weekly chart. We have a similar look of a rising wedge, but here we're short of the highs. The SPY is above the highs. We attribute that, of course, the big cap's been lagging as of late, but other stocks, as we see the rotational element of the market, been working out. So if you have rotation plus Apple and NVIDIA coming back, that's going to be good enough for the SPY to make new highs. But not much for the Qs, because you got Apple and NVIDIA, but then the other names stalling and they're coming down, so we're not seeing the same recovery as we've seen in the SPY. What's really important, though, I want to take you back to 21 and look at the MACD wave on the weekly chart. The wave ended the moment we've broken the trend line. So when we fast forward to the MACD wave that we got right now, we know that it's coming to an end. It's exhausted. It's showing negative divergences, but the confirmation will be if we lose the trend line. And if we do, the MACD will be below zero, an indication that we have entered a bear market in the Qs. Between now and then, though, we have a drop of about 8.5% to the trend line. Folks would say, what do I do about that? Can I trade that? Well, earnings are going to dictate. So you're taking a little bit of risk here in assuming how earnings will look like. So I'd leave that decision up to you. But the importance of the trend line and the wave is if we go down to that trend line, it wouldn't just be a confirmation from the MACD indicator alone in the weekly chart. It'll be a confirmation by a lower high and a lower low. The end of the bull wave already behind us in the summer, and we begin a new bear wave. And again, if the Qs go down, folks, it's going to go down because of Apple, Microsoft, Nvidia disappointing. What do you think that's going to do to the SPY? The SPY will also go down. Does that mean that other sectors like energy or metals or financials or healthcare should necessarily go down? Not really. So we might enter a phase where the indices and the big caps and the AI mania go down and enter a bear market. But we see other stocks breaking out and moving higher. So right now it becomes sort of a picker's market, an active management kind of market. So you have to look at each individual chart on the weekly chart, sector by sector, name by name. On the IWM daily chart, what do we do here? We've stalled Friday's session, but after big gains Monday all the way to Wednesday. Now we can argue that we're stalling in a bull flag pattern, and in time we'll break out and challenge 228.63, which is the previous stop. Now what if we pull back though? You gotta be really careful not to be sucked in a bear trap, because the pullback could be an ABC breakout. So you have to go back to the intro of this video. Is the IWM going down with context, meaning bond yields going down in a flush because we have recession fear or recession data? Is the IWM flushing down because we have a pop higher in bond yields because we got inflation risk? If the answer is no, it could be just a pullback and then we see a breakout of an ABC pattern. So before you short the IWM, your confirmation number one is the context. Is it just pulling back, or is there a context to why the IWM is pulling back? Because of the behavior of bond yields, because of the behavior from the macro data. And number two, you need to look at a level here, 222. If you break that, then okay, we have a failure. And if it comes hand in hand with context of why bond yields popping higher or down with inflation or recession risk, then you have a double confirmation to short the IWM. But right now, the risk is to the upside. The dollar daily chart, been blasting higher, didn't stop, but way overextended and exhausted right now. It faced, as you can see in orange here, the 200 days moving average and gave us a bearish engulfing candle. The assumption is we continue to see weakness in the dollar, maybe for a day or two until we get the data that we're waiting for in the PMI, or the wild card of geopolitics just shove its way in. But absent of that, we think the dollar is going to continue to pull back, and that's going to be good for metals, including gold. So you see gold with a breakout. There's no harm in hedging, by the way. Hedging is the strategy for now. You got to hedge, especially if you think the dollar is going to rebound. So if you see the dollar pulling back, then you see a reversal candle, then you need to begin hedging again. But right now, gold is breaking to the upside, still got room to continue to go higher. And then you have the SLV silver, huge squeeze on Friday. And we think we have more where that came from, especially if the dollar is going down. You'll see more. You see momentum, not overbought yet. Still got plenty of room on the other side, the MACD, to go positive. And again, folks, if we switch to a weekly chart, is the SLV silver forming an inverse head and shoulder pattern? The answer is yes, and it's breaking above that neckline, which is a bullish confirmation. What about crude oil, though? It's been trending down based on China and the alleviation of some fears on the geopolitics, but the vast majority of weak hands are out right now. And the chart also invited some shorts to the picture, meaning that if you get any good news right now in oil, you'll see short squeeze again. That could come from the Chinese front, more stimulus from China, more good news from China. Either the stimulus or the good economic news can push oil higher. And the other factor is the geopolitics. Any flare-up in the geopolitics, higher we go. Not to mention, of course, with the dollar pulling back, that could also be a factor where we see oil moving up. And again, with the shorts that we've accumulated as of late in this pullback, we could see bigger pops in crude. But it is important that we maintain a pattern of higher lows, because if that's broken, then we got a problem. I only think it's going to be broken if we have recession fears, which right now we don't have them, at least not according to the data that we got as of late. But from the investor perspective, you're not really trading crude oil or USO, you're trading or you're owning the XLE and individual energy stocks. Those are okay for now. We see the momentum in the weekly chart changing from bearish to bullish. It is imperative, though, that we begin to move higher this week. Because if you lose the 20 weeks moving average, close below the 20 weeks moving average in white, that's going to be a problem. It's going to be a failure to break out. And again, I don't think that's going to happen absent of reintroducing recession fear. What about the 30-year bond yield? Daily chart, what do we see here? We got to the resistance of about, let's say, 4.40. We pulled back as we anticipated Tuesday, Wednesday. Then came retail sales data. And we bounced from the resistance line, now support line. That's the sloping line, of course. So what do we do here? Since we don't have any macro data that could pop bond yields higher all the way till Thursday, it could be consolidation between now and then underneath 4.4%. And consolidation could bode well for the yield-sensitive assets, risk-on and risk-off alike, because right now we have no context on why we see the moves up or down on a daily basis. But say the PMIs come out on Thursday showing a recession warning, we see the 30-year flushing down, then you know what's going to happen. IWM, XHB, KRE will all go down. What if the PMIs come out and show inflation risk, where the prices are going higher in a big way, and we see a pop in the 30-year bond yield? Then you know that this is going to be bad also for the IWM, KRE, XHB, all of the yield-sensitive assets. So for now, I would say that Monday, Tuesday, Wednesday, you can still play the yield-sensitive stuff based on the individual technicals. If you like the IWM, okay, stick with that. If you like the KRE, stick with that. The XHB, stick with that. Whatever you like. But the risk is going to amplify once we get to Thursday. And if you have a break above 440, you have to consider that as a risk too. Because when you look at the weekly chart for the 30-year bond yield, the daily might limit the upside, but boy, the weekly we're moving from bearish to bullish momentum. And I think that the 30-year bond yield in time will make it above 4.4 and break all the way to the upper Bollinger Bands. And at that point, let's brainstorm the reasons. If you agree with me, looking at the weekly chart, that we're heading higher, why would we head higher to this magnitude, all the way to the upper Bollinger Bands? I think it's going to be because of the reintroduction of the inflation fear. In the meantime, right now we see the XHB with bond yields pulling back, at least last Tuesday, Wednesday. We see the XHB holding on, forming perhaps a bull flag pattern in the daily chart. You'd like to see a failure, such as losing the 20 days moving average, before you take a short trade on it. And to be honest with you, if you're going to trade the XHB, you're better off taking a long-term trade where you see the XHB trading at. Because right now in the daily chart, the Bollinger Bands are so tight that the range of trading is going to be tight too. The upside is limited, the downside is also limited. If we look at the IYR weekly chart, also bond yield sensitive, but on the defensive/risk off side, we moved higher this week as we see bond yields pulling back a touch. Problem is, if we think the 30-year is moving higher in time, then wouldn't this play out as an inverse ABC pattern? This is something to keep in mind. And if you see that we have a little bit of failure in the daily chart of the IYR, it's happening on the heels of the 30-year bond yield breaking above 4.4. You're going to put two and two together and assume that the inverse ABC scenario is going to play out. What about the KRE regional banks? On Thursday's video, we talked about a possibility of a rising wedge. We see profit booking on Friday because the KRE was one of the top performers for the week. This is exactly what we got. Now it depends on how do you see bond yields behaving. If we think that bond yields will consolidate or dip down for technical reasons, Monday, Tuesday, Wednesday, I think the KRE will do fine. If you see them going higher for negative reasons, like inflation reasons, or going down for recession reasons, then that's not going to be good for the KRE. Which means, by the way, not going to be good for the IWM because the KRE is a big weight in the IWM. What about the VIX 4 hours chart? What do we see here? The next support that we got, since we've broken 20, I got 17.6 as the next support. And if you look at the daily chart, notice the MACD indicator. Is it rolling down from bullish to bearish? The answer is yes, which means that this is positive for the market, at least the big caps, the indices for now, unless there is a change. And that change would be if somewhere this week, the VIX makes it above 20 and closes the day above 20. Then you'll see a change in the daily chart where the negative momentum lasted for a couple of days. Then it moves back to being bullish again. And that's going to be a warning sign for the big caps. And speaking of, here's the big Kahuna apple. What do we see here? We do have a break right now above the consolidation pattern. That's the good news. We've closed above 233. That's the other good news. But the bad news is we're short of the highs for the week, 237.49. Now, if you look at the weekly chart for Apple, there is a break to the upside, which again should support the SPY and the Qs to move higher. The problem is it reliable? With the MACD wave already at the peak, you can't really extend it and go higher for too long. And the RSI is already closer to being overbought. And the vortex indicator in the weeklies, or at least wanting to change into bearish versus bullish. Are we about to go back to the highs in Apple, stall, then face earnings and flush down, forming a top and a confirmation of the top with the double top. And what is that going to do to the SPY and the Qs? I think that's where we're heading to. Right now, you got the optimism of, oh, Apple is about to reveal the AI features. But once they reveal the AI features, you're probably going to get sell the news. And after that, you have to assume the earnings risk. And I think that's what's going to pull it back and end the weekly wave. What about China? So we look at Alibaba, the most important name. On the hourly chart, are we seeing sort of an inverse head and shoulder pattern? Sure, I would have loved to see a break above and a close above 103, but we never got it. If we get it Monday and the dollar continues to go down and we're not getting any more bad news from China, I think we begin to attract buyers again into the China theme. And we see BABA, FXI, KWEB all moving higher. What about the souffle Tesla daily chart? What do we do here? We know that we got this sort of a bearish, flaggish kind of pattern. We know that the buyers are not showing up. We know that the sellers are not showing up. Clean up the chart a little bit. The 100 days moving average in red is the line in the sand. You close below, we're probably going to flush down. But you got to understand that we have all the way till, I believe, Wednesday when Tesla reports. So nobody wants to assume the risk before Tesla reports. Now, if it breaks the 100 and closes below the 100 Monday, maybe it'll be worth it to trade all the way to Wednesday, some puts. But again, you're assuming a lot of risk here. On this one, you're on your own. This is a gamble. If you look at the technicals aside, they're suggesting that Tesla breaks to the downside. But we know that earnings is a fundamental / a mechanical element, an event. It's not really a technical one. So on this one, you're on your own. But if I had to speculate, the only thing I have to speculate on is the technicals right now. And they look negative. NVIDIA, hourly chart, what do we see here? You see the reflection of the SPY in this chart. Consolidation, then a break, and a formation of a bullish trend. Did we break the trend so far? Not really. Did we break the highs of the week? Not really. So right now we're stuck. Depends on further feedback. Options trading, AI news, technical setups, that's what's going to influence trading in NVIDIA because you don't have any news coming until earnings of Lam Research, IBM, and other reporting AI stocks. The challenge for NVIDIA right now, will these earnings, we don't have a lot of them, by the way. We have Lam, and that's about it. IBM is more on the hardware side. But if we begin to see slowdown in orders from these companies, it could impact NVIDIA negatively. We break the trend line, maybe revisit 125. But what if they come out affirming Taiwan's perspective? Then we're probably going to see NVIDIA going higher. So in this one, right now, you look at the weekly chart, we have a bullish break above the consolidation pattern. But we're still short of the highs. We didn't close above the highs. I think we stick there until we get the earnings for more impactful AI names. Think about Microsoft, because that's the sugar daddy that's been funding NVIDIA. And lastly, Bitcoin tulips. What do we see here? We got a bullish break. And with the dollar pulling back and Donald Trump taking over the polls, you have multiple factors here that could support Bitcoin to continue to go higher. The way I'm playing it right now is puts on BITI, B-I-T-I, which is the inverse index for Bitcoin. It's the cheapest options that I could find. And I'm going to play it that way right now. If I feel more confident, I'm probably going to trade Bitcoin futures, which will cost a lot more. But right now, since we have a break, no confirmation yet, this is the way I choose to play it. Puts on BITI. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar this week? Monday, we're going to have a bunch of Fed zombies speaking along with U.S. leading economic indicators. So again, the technicals will be more dominant. Tuesday, October 22nd, we have another Fed zombie showing up from Philly. So the assumption is with earnings having an impact, but again, none of the big names reporting on Tuesday. So it's going to be more of the technical side. What is the dollar doing? What are bond yields doing? What are the individual big caps doing? Wednesday, the 23rd, we do have existing home sales on top of the Fed beige book. But most importantly, it's going to be an earnings kind of phenomenon. You have Tesla, you have Lam, you have IBM, so you have a little bit of AI feedback, which could impact the bigger names and thus impact the indices. Thursday, the 24th, this is when the macro takes over. We have initial jobless claims. But the most important piece of data will be the flash PMI, services, and manufacturing. That comes, of course, on top of new home sales. We're going to conclude on Friday, the 25th, with durable good orders and the final reading of consumer sentiment. And that's, of course, going to be important. And Friday, I think it's going to be a combination of the macro, the technicals, and also some options expiration. Not as big as this week, but it also has an impact. That is, of course, absent of a surprise from a wild card coming from the geopolitics. Absent of that, what we talked about today in this video is your guideline for the week. And with that, folks, if you found this video helpful, please return the favor by pressing the like button, leaving a nice comment in the section below, and consider subscribing and joining us as a member. The coverage resumes tomorrow. In the public channel, we have the macro video. We didn't do it this week, we'll do it this Monday, promise. We have a really good discussion for you. And of course, then after that, we have the market analysis, and that's going to be for the members. But until then, folks, that's all I got for you for now. Thank you for listening, thank you for watching, and I'll be talking to you again tomorrow. Good night.
I love gold so much that I even lost my genitalia in an unfortunate smelting accident. Hence the name Gold Member.